So, good evening, everybody. We start right on time with our webinar. Ladies and gentlemen, dear colleagues, a very warm welcome on behalf of the Austrian Trade Union Federation, ÖGB, and Arbeiterkammer trade union think tank based in Austria. My name is Dominik Bernhofer, and I'm the head of the tax department in Arbeiterkammer in Vienna. And today's webinar is about the implementation of a global effective minimum tax rate in the EU. We have great guests today, proven experts in the field of international taxation and the minimum tax in particular. Johannes Becker is professor for economics and public finance at the University of Münster, and authored a study on the topic of minimum tax implementation in the EU with Joachim Englisch, who is professor for public law and tax law, also at the University of Münster. And we also have Johann Langerock with us, who is a tax policy advisor to the Greens EFA in the EU Parliament. We start the webinar with a presentation by Professor Becker on the economics of the minimum tax. After that, Professor Englisch will move on with the special legal challenges of EU law for minimum tax implementation. And after these presentations, Johann Langerock will give us a short political comment from the perspective of the EU Parliament. And after that, the floor is open for questions and discussion. We are already nearly 100 people in the webinar. I think this highlights the great interest and the great importance of the topic. I think with the G7 agreement 1 month ago, a global tax deal is within reach, and from a European perspective, of course, the question in Europe is how to put that advancing global deal in a directive. We also have a statement by the Inclusive Framework. A few minutes ago, Johan put the statement in the chat. Around 130 members of the Inclusive Framework agreed on it. So things are moving on as we speak. And Arbeiterkammer and ÖGB have been pushing for a minimum tax for quite some time, because we see it as a chance to curb not only the profit shifting by corporations, but also the tax competition of countries, which we see as a problem of equal importance to the question of international taxation. Of course, as we speak, also the resistance of some countries is growing, also of some EU countries, which question the economic benefits of the minimum tax, but also the legal possibilities. And that's why we think the study by Professor Becker and Professor Englisch is coming at the right moment, as we need also for the political discussions that are coming up. We need answers and arguments to these questions. Some short technical notes before we start. The webinar is recorded and will be made available afterwards for those who are not with us today. And concerning questions and comments, please write them in the chat and do not wait until the discussion round starts. The chat is open right from the beginning. This is especially important for questions of understanding, because we can probably discuss them right after the presentations. Now, enough from my side. Again, I'm happy to have you all with us. And now I give the word to Professor Becker on the economics of the minimum tax.
All right. Can you see my presentation? Great.
Yes.
Thanks for having me. This is really Breaking news, what we just heard. So the timing couldn't have been better. 1st of July, and 5 minutes before we start this webinar, the OECD tells us that actually 130 countries agree to what we will discuss today. There seem to be 9 countries left who have not yet agreed, as the statement says, that maybe come in the next few days, or maybe we have some permanent resistance here. All right, so effective minimum tax rate implementation in the EU, why and how? Yeah, I'm Johannes Becker. I will give the first part of this presentation, and after around 15 minutes, hand over to Joachim. I think it makes sense to start with some short history, as we live in historical times, as you see. So if we go back 10 years or so, right after the financial crisis and amidst the euro crisis, back then it was quite clear that we would have an increased need for revenue, and at the same time we got increasing reports of multinational firms engaging in base erosion and profit shifting. Right, there were data leaks, there were econometric evidence, newspaper reports, and so on, and therefore the OECD launched the BEPS initiative that ran from 2013 to 2015 and was, well, included some targeted measures that were successful, but at the end of that, it became clear that the core problem of international business taxation haven't been solved. Okay, and therefore the process went on, and the inclusive framework were established, and the G20 task force on the digital economy that were meant to to pursue additional measures and come up with something with solution proposals to challenges due to the digital economy. And in 2018, 2 important documents were published. One from the OECD, the interim report that and 2 council directive proposals, and both of these set of documents had in mind that some proposals to solve the nexus problems. So firms without a physical presence in countries should be liable to tax in the source locations, and some proposals for a digital levy. But then something happened, and the approach shifted from a targeted approach on the digital economy to a broader approach. And so just a year later, and I think a little bit inspired by the TCJA that had this guilty provision, some kind of minimum tax on multinational firm profits. And then the G20 summit in 2019, in the context of this summit, there was this program of work that for the first time proposed what we are discussing now, an effective minimum tax on a global scale, and the Pillar 1 measures that we know now of to be Pillar 1 measures, the shifting of taxing rights to the market economies. Okay, so now we have these blueprints, and so I was about to say, no, we are waiting for an agreement, and 5 minutes before I started talking, this agreement came into existence, and we can now deal with implementation. Now, I think the statement says that implementation issues will be solved or dealt with until October, but I think these implementation issues will occupy us for the next 2 years or so. Okay, and for as Europeans, implementation in the EU will be of central importance, and this is what we will talk about now. In any case, I planned to say with or without an agreement, but now we can talk about with an agreement on a global scale. the blueprints on pillar 1 and pillars 1 and 2 will be the starting point for these implementation talks. Yeah? And therefore, so we now focus on pillar 2, and I will now spend one slide to quickly talk about what this is about. What is global about the pillar 2 measures? The effective minimum tax is based on 4 rules. The income inclusion rule that gives the right to the ultimate parent's jurisdiction to levy a top-up tax on low tax income of their own foreign subsidiaries. And this is backed up by this switch over rule that solves issues due to double tax treaties. And on the other side, the under-tax payment rule that allows the source country to deny full tax deductibility for payments to related parties in multinational firms that have some low tax income. And then the subject to tax rule that allows for withholding tax, although double tax treaties rule them out. That can be implemented even if before the income inclusion rule or the UTPR are applied. So this is kind of priority here. But if you only look at the IIR and the UTPR, the income inclusion rule has priority over the under-taxed payment rule. Then in our report, we go into detail where the devil is, and so we split the whole implementation to 9 distinct steps, and then deal with all these technical details that come up and provide some discussion and provide some information how the negotiations are going. And if this sounds technical and if this sounds boring, you're not wrong, but this is important, okay? Because this will ultimately decide whether the effective minimum tax is effective, if this is an effective instrument against BEPS or not. So here's quickly these 9 steps. The step 1 is to identify the effective firms, so who will be subject to these rules. Step 2 is to identify each entity's local profit. And you may be familiar with this discussion. The blueprints suggest to take financial accounting numbers moderately adjusted for tax purposes. There must be, of course, some kind of harmonized approach here, because BEPS is about reducing the tax base using local tax provisions. So we need some common standard here, and financial accounting numbers is maybe a good start to do that. Step 3 is to identify the covered taxes. So which taxes are actually taxes on profit? And if step 2 identifies the denominator of the effective tax rate, step 3 identifies the numerator, okay? In step 4, all entities within one jurisdictions are lumped together. We call this jurisdictional blending. And if the ETR within a jurisdiction is below the minimum threshold, then the GLOBE rules would apply. Steps 5 and 6 are very important. Step 5 deals with temporary fluctuations in the ETR and has the effect of smoothing the ETR time series, so there are tax and loss carry forwards. This is actually not trivial. The report we wrote, in the report we give some numerical examples that I think explain them in a way that you can understand it without being I don't know, an accountant. And step 6 is even more important. I think this is one of the crucial steps here and deals with carve-outs. So the blueprints propose to allow for exemption for the normal return, what can be understood as a normal return on tangible assets, and some percentage of payroll or personnel cost. This, of course, narrows the the tax base for the minimum tax makes it less effective and provides some margins at which firms may use tax planning and may manipulate. So this is something which you can criticize, which we are criticizing actually, but it's in the blueprints. And as I said, this will be the starting point for the actual implementation. In step 7, the top-up tax is calculated. There, at least from my understanding, there's still not an agreed upon a minimum tax rate. So the statement that was just published says that at least 15%, but it's not sharply 15%, it's at least 15%. So there seems to be not an agreement yet, but maybe that's just, I'm just missing information. Yes, in step 8, then the jurisdiction has to be identified that levies the tax, that applies the income inclusion rule. And if this doesn't happen, if there is no jurisdiction that actually does this, step 9 comes into play, where the undertaxed payment rule is applied. Let me just say, so this is all. Yeah, I think you can see that this is quite technical. In the report, it's around 23 pages. But this is, I think, sufficient to get you up to speed and to get a very good understanding of how the globe works. Okay, you can. The report is written in a way that you can read each chapter on its own. So chapter 2 is about that. Moving on. So why do we need it? In chapter 3 of the report, we extensively discuss the pros and cons, and we argue that there's a very strong case in favor of effective minimum taxation, but we also, of course, deal with the counter arguments. The pro arguments are the following. We have a fundamental problem with base erosion profit shifting, and this is due to tax rate differences. Okay, so if you have a zero rate tax haven and you have a firm in Germany shifting €1 from Germany to the tax haven, has a return of 30 cents for each euro. Yeah, this is something for a profit maximizing firm. This is hard to leave on the table. Yeah, and this is just due to this tax rate difference. What the minimum tax does is to reduce that tax rate differential. Yeah, and therefore it curbs profit shifting, and it enhances the capital allocation, because for the same reason it may make sense to shift tangible assets to these low tax jurisdictions, even though there is no good reason from a purely business point of view. It has to be said that these carve-outs limit this effect. Yeah, if the normal return to tangible assets is exempt from minimum taxation, then of course this pro argument is constrained, and it mitigates tax competition for 2 reasons. So low tax jurisdictions have an incentive to increase their tax rate. Why? Because firms pay the 15% anyway, and by increasing their tax rate, they get some more revenue without making the firms pay more. What speaks against minimum taxation? One important argument says that, well, the minimum tax as it is proposed in the blueprints mostly benefits the ultimate parent countries, and these are mostly rich capital exporting countries. And this is true. This cannot be denied. I think there may be good political reasons to stick to that proposal. The compliance cost may be lower compared to a case in which the undertax payment rule has priority. And it must be said that other countries, especially developing countries, would benefit from the minimum tax, even if they are not those that apply the income inclusion rule, due to lower profit shifting and, for instance, the subject to tax rule. Another counter argument is, of course, the higher compliance and enforcement costs. This cannot be denied either. The system gets a little bit more complicated. But as I said, by reducing the pressure in the system to shift profit, it may reduce the pressure to implement these sometimes very complicated tax planning schemes, and therefore reduce the complexity on this side. And maybe some of these anti-BEPS measures may become redundant in the presence of an effective minimum tax that is applied widely. Some people say that a minimum tax would stifle welfare-enhancing forms of tax competition. We would argue that the tax competition that we observe now is not of the welfare-enhancing kind. And there's good reason to think that it's currently not about which country is the most attractive production location. It's mostly about which country has the smartest ideas to offer schemes that lead to base erosion in some other countries. And this is not something that has anything to do with welfare. It violates capital import neutrality. Well, that's true. The current system heavily violates capital export neutrality. I think with a widely applied minimum tax, the problem is of minor importance. And finally, some people say that this limits the sovereignty of nation states, so their ability to set low tax rates. Well, with the current proposal and the carve-outs, and this is of course of limited importance, but I would also argue that in a world where there are strong externalities, where tax rates, tax policy in one country affects other countries as well, national sovereignty is not of the highest priority if the tax policy in one country may really have detrimental effects on others. All right, I'm already running out of time, so let me make this quick. The report thoroughly discusses past experience with any kind of minimum tax, diesel taxes, alternative minimum taxes are applied in some countries, CFC rules, which can be understood as some kind of minimum taxes, the local business tax in Germany, local property taxes in Finland, or in all these systems we have some kind of minimum tax, and we discuss the experience with them. Mostly the evidence is mixed, but we argue there's good reasons that minimum taxes can do the job for which they are designed. And finally, and this is my last point here, we discussed the impact assessments. So here, this is the impact assessment by the OECD here for 12.5% tax rate, and this including the guilty. This is a measure estimated to give around 75 billion euro more of revenue, or dollar more of revenue. But this is just, yeah, this is if you're interested in that, the report gives a detailed account of that. And that's it. And now I hand over to Joachim.
Yeah, thank you very much, Johannes. I hope everybody can see me. I should try to share my slides now. Can you see the slides? Does it work?
Yes.
Yes, great. So, oops, I'm sorry. I'll talk about the legal framework for an EU implementation of what apparently has been mostly agreed today by the inclusive framework. We'll first have a look at the relevant issues and then at possible solutions. Now, you find 4 issues here on this slide, or I should rather say presumptive issues. The first point is the competence of the Union if it were, as the Commission certainly plans to do, if it were to enact a directive in order to implement the international agreement, so globally the effective minimum tax. And here some commentators doubt whether the Union has the competence to do so. I mean, it would have to be the internal market competence under Article 115, because the Commission is very reluctant for some good reasons to use Article 116. So it would be 115. So some say, well, internal market competence, that's a problem because the internal market is a guarantee of healthy tax competition, and the minimum tax is obviously about curbing that tax competition, so it runs counter the internal market ideal, and therefore you can't have a harmonization to that effect based on this competence. We would strongly disagree, and Johannes has already mentioned the main reasons. We believe the internal market is about efficient allocation of resources and capital, and for the reasons that Johannes has explained, the current situation of unfettered tax competition, excessive tax competition, is not leading to efficient resource allocation. It rather distorts the allocation of resources and capital and investment within the internal market. And Article 115 is precisely about the removal of such distortions, so the competence of the union, in our view, exists. That should not be a problem. As to the principle of subsidiarity, which requires that the union should only act if member states can't do it just as well on their own. Well, you might think that since there is an international agreement, everybody will kind of or could implement this agreement. So why do we need harmonization still at the union level? Essentially, in our view, for two reasons. First, the agreement is not even politically binding for all member states because one, Cyprus is not member of the inclusive framework. And second, and more importantly, it is just a political agreement. It will very likely not be a minimum standard. So the member states of the inclusive framework don't have to implement it, I would assume. And that means if there is to be uniform implementation by all EU member states, we need harmonizing union legislation to that effect, which means that the first point is not really an issue in our view. It's different with the second point regarding the compatibility of the globe as it is proposed in the blueprint with the EU or EEA fundamental freedoms. So the question, could we just implement the blueprint or whatever will be the agreement, looking more or less like the blueprint, into the European Union without any modifications? Without infringing upon the fundamental freedoms? Could that be done without the Court of Justice objecting to such a measure? Or is it not the case that we need an extensive carve-out for substantial activities to make it compatible with union law? And here we certainly have to distinguish between the different collection instruments, but at least regarding the most important one, the income inclusion rule, we would have a problem with an unmodified implementation because it works similar to a CFC regime. And regarding CFC regimes, we have the Cadbury-Schweppes line of judgments of the Court of Justice telling us that this restricts the fundamental freedoms, and it is only justified if we do have this extensive carve-out, and the same would go for the UTPR rule, and you find the relevant case law in our report in Chapter 4, by the way, mainly cases such as Eurings and Lexler. So here we do indeed have an issue. Same goes for the question, to what extent would an implementation of GLOBE by EU member states based on the EU directive still require treaty amendments? Obviously, when it comes to the switch over rule and the subject to tax rule, which Johannes has mentioned, these are about treaty changes, so they do need treaty amendments to that effect. The question is rather whether the income inclusion rule and the UTPR also requires such treaty amendments. When it comes to the income inclusion rule, this is certainly not the case in treaties which include a saving clause, such as we now find in Article 1, Paragraph 3 of the OECD model, the current one. But not too many treaties actually do already have such a saving clause. For all the others, if the logic of the reasoning in the OECD commentary regarding CFC regimes were accepted as correct, then for that logic, income inclusion rule should also be acceptable, should not be considered to violate Article 7 of treaties. So this should indeed be the predominant opinion we would expect. So in the majority of treaty scenarios, there should be no issue with the income inclusion rule, even though this is not entirely undisputed. Whereas with the UTPR, it's clear that there are serious doubts as to its compatibility with Article 24 of the treaties or the non-discrimination clauses. And so altogether, it would be good to have some clarification here, at least, maybe even changes with regard to the UTPR. And finally, and this is then chapter 5, the last point, we identify some need to align the existing EU legislation with a new harmonized EU minimum tax, mainly as the special anti-abuse regimes that we find in the ADAT, depending on the interpretation, also maybe some conflict with the parent subsidiary directive, not so much actually with the interest royalty directives due to some EU ECJ case law. But in any event, it's usually about priorities, and these can be clarified either in the minimum tax directive or by amending those existing directives. Should not be a problem if we get agreement on EU minimum tax directive. So that means, bottom line, we only have two real issues, and that is the compatibility with the freedoms and the question on how to amend or to what extent we need to amend tax treaties. And these two issues, we will now discuss a few solutions. Let's first have a look at the free movement rights. The first point here is it should be possible to design a European minimum tax in a way that ensures that the scope of the minimum tax always falls within the scope of the freedom of establishment, Article 49 of the TFEU or 31 of the EEA agreement. And that means if that is the case, because the control criteria required for a group to be caught by the minimum tax are also control criteria that activate the freedom of establishment, then EU case law tells us the freedom of capital movement is superseded, is replaced, and so we don't have application of free movements right in third country scenarios. So basically the union legislator would be free to implement GLOBE in third country relationship without any restriction by fundamental freedoms. Now the group criteria envisaged in the blueprint are those of IFRS 10. We believe they always activate a freedom of establishment. You might disagree in some marginal issues, then maybe there would be some minor modifications in place, but it is doable. And that means we only need to deal with fundamental freedoms in an intra-EU environment. And here the question then arises, what do we do? We could have an extensive Cadbury type carve-out, as some would have it, as some suggest. So that means a carve-out that limits the application intra-EU to wholly artificial arrangements on a case-by-case analysis. Obviously, there is no point then really in doing this, because this would render GLOBE ineffective. The effective minimum tax is a broad anti-BEPS instrument, and it is intent on setting a floor to tax competition, and you can't have that if you have this type of carve-out. So that is not the way to go in our view. You might then, as many also tend to, as I've seen in discussions, then just count on some generosity on part of the court. If it's union legislation that implements the GLOBE rather than national legislation by each individual member state, the court might be more restrained in striking it down. We have case law telling us the court is willing to accept additional justifications that it would not accept in a national context. It is in general more generous regarding the proportionality requirement with the union legislator. So that might be something, and many seem to think that it's enough. But in our view, it's a riskier approach. First, we don't know where the court would draw the limit, whether it would really accept a total derogation of the Cadbury Schweppes requirements is not so sure. And especially not in a case that might not be so unlikely in the beginning, in the case where we have to have resort to enhanced cooperation first, because maybe 2 or 3 member states are not willing to go along. So the others enact the directive by way of enhanced cooperation. And then we don't know how lenient the court would be regarding fundamental freedoms in such a situation. Which is why we have a different proposal. We propose to think a little bit out of the box and to modify the GLOBE collection rules, only the collection rules, and to collect the top-up tax by way of the avoider pays principle, as we have adopted, instead of the income inclusion rule or UTPR. And I have tried to illustrate the idea a little bit. So here we have a multinational with the ultimate parent entity in member state A, which is a member state with a relatively high tax of 20% effective tax rate, or say medium effective tax rate. And that parent has 2 subsidiaries, one also in A, the other one in low tax jurisdiction B with an effective tax rate of only 5%. And also two branches, permanent establishments, one in the same member state A and another one again in member state B. Now, regarding the sub 1 in B and the PE1 in B, they are in a low tax jurisdiction. Their ETR is 10 percentage points below the presumed minimum rate of 15%. That means, the top-up tax will be levied first on the profits of the sub, and they will be paid under the income inclusion rule by the ultimate parent entity. And then we have the PE, also a top-up tax in our example of 10, and that will also be paid by the ultimate parent entity by virtue of the income inclusion rule plus the switch over rule in case necessary, meaning that the tax jurisdiction of member state A is extended to the PE in member state B if bilaterally in a tax treaty the exemption method is agreed upon. This is then overwritten, is superseded by the switch over rule, and that allows member state A to extend its jurisdiction over the profits of PE1, and so it can apply the income inclusion rule, and again the ultimate parent as the head office unit of the PE will pay this tax. And this is where the problem arises in the IIR situation, so when it comes to the profits of sub 1, because here the parent has to pay 10, whereas in the comparable situation of the parent having a local subsidiary, the parent has to pay 0 because it's the local subsidiary itself that pays its tax on its profits. And this is where the court in Cadbury has said this is discrimination of the cross-border situation, whereas the court has not subjected to the second scenario where the jurisdiction of member state A is extended over the PE of the parent in the other member state, because here a foreign PE then leads to a tax payment by the head office to the same extent as the head office would have to pay taxes for its local PE's profits, obviously. So there is no discrimination here in the view of the court in the Columbus container judgment. And now our idea is basically to replace the income inclusion rule regarding subsidiaries and to instead have the subsidiary itself, that's why we name it avoider pays, pay the top-up tax directly to the member state that would collect it under the income inclusion rule, so the ultimate parent entity jurisdiction. And the effect is, of course, that we do not have any detrimental treatment of those profits anymore, because now it is the sub that is a taxpayer and it pays even less tax, and certainly not more tax in almost all relevant scenarios than a local subsidiary would pay. So the ultimate parent entity, the parent, doesn't pay any tax anymore, just as in a local case. The subsidiary now has to pay a tax, but it would also have to pay a tax if it were a local subsidiary. So we extend the Cadbury-Schweppes logic technically to the subsidiary, which should make it acceptable for the court. Now, normally we couldn't do that so easily because tax treaty law would not allow to do this under Article 7, but we have a case law of the court and also scholarly opinion that clearly states, and correctly so in our view, that if it's union law requiring this, it overwrites any detrimental tax treaty law between the member states, so this can be done. And we can even add an element of a compliance facilitation here. We could include a one-stop shop in the country of residence of the subsidiary, so that the subsidiary doesn't have to file the top-up tax return in member state A, but can do so in its home member state B, and then also pays the tax in member state B, and member state B under clearing system then forwards the money to member state A, just as currently already happens in other systems such as value-added tax under a harmonized system of the EU, or as the Commission has proposed for the digital service tax. And this mechanism would even allow to have a different allocation of the revenue, so it would not necessarily have to go to a member state A anymore, because we don't have the income inclusion rule anyways anymore. It could also now, for example, go directly to the EU as an EU own resource if that were politically desired. So this is the solution we propose for this problem. And then very quickly, what happens with tax treaty law? Well, again, as I just said, intra-EU wouldn't be a problem anymore, because if required by union law, then it would supersede any contravening tax treaty law. So we only have an issue with respect to third countries. And here, of course, we could just say, well, then we just simply do a treaty override. We can do so. Even countries which are normally constitutionally barred to do a treaty override would then be in a position to do so, because if required by union law, any contravening, even constitutional national law, would be non-applicable, so they could do it. But clearly, politically, this would be an undesirable outcome, so there should be only a measure of last resort. And I'm sure the Commission would also be very reluctant to propose this, as we could see in the significant digital presence proposal, where they also were quite careful not to provoke a treaty override. So what's the alternative then? Well, bilateral amendments, theoretically that could be done, but most member states have dozens of agreements with third countries. That is a very cumbersome, lengthy procedure, so it's impractical in the short and medium run. Clearly preferable would be the multilateral convention that the OECD envisages in the blueprint. But that might take some time, as we could see the multilateral instrument. So an idea might be a staged approach. If the EU wants to move quicker than we get the multilateral convention, the idea could be to start only with the income inclusion rule, which would still apply vis-a-vis third countries. And here, as I said, it is, first of all, the most important collection mechanism. Second, it is in most situations not a violation of tax treaty law, in our opinion, and that should also be predominant opinion. And in the few cases where you could argue, well, in a certain old tax treaty contract, maybe it would be considered a violation, then at least the treaty override is very limited in scope and should therefore be politically acceptable. Well, that's it from my side. Thanks a lot.
Thank you very much to you two for these excellent presentations. There was a lot of technical analysis, but I think it shows very well that a minimum tax in the EU is not only desirable, but also possible. I have not witnessed any questions of understanding yet, so I think we quickly move on to the comment by Johan, who I think brings the discussion more into the field of the political economy of tax policy making in the EU. And Johan, we are very happy to hear your thoughts. The floor is yours.
Yes, hello everyone. So indeed a historic moment, as a statement of the OECD Inclusive Framework was published a few moments ago, and actually also influences my comment, because the OECD Inclusive Framework coexists of 139 jurisdictions, but only 130 of them have signed up to the agreement, and actually the 9 unwilling, or the coalition of the unwilling, so to say, in those are 3 EU member states, Estonia, Hungary and Ireland. Cyprus is not a member of the inclusive framework, so one based on the public statements made by Cyprus lately could expect also Cyprus to have joined such coalition of the unwilling. So we immediately see a problem here for any EU introduction of the rules, because taxation needs to be introduced through unanimity. There's only a limited role for the European Parliament, a consultative one. And it is clear at the moment that there's no such unanimity in the EU to introduce a minimum effective tax rate, because now we see the statement made, but before we have seen already Cyprus making quite aggressive statements against, Hungary as well, Ireland, even Poland had joined that group together with Hungary, which is more and more becoming aggressive in the EU as well in terms of taxation. So we see a lack of unanimity, and that boils down to the question of how will a directive be voted in the Council without unanimity. And politically this will be difficult because the calendar is quite ambitious. The OECD has a calendar saying that in 2022 there should be introduction of the rules, which should be then enforced as of 2023. And the Commission recently has also made statements to make clear that early 2022 a proposal will be made on the introduction of these rules. In case we have no unanimity, there would be a few options left, which is enhanced cooperation. But how does this influence then the design of the rules and their compatibility with the court? Or there is the option of unilateral measures, meaning that EU member states go solo and then also need to make sure that the rules are compatible with the EU freedoms and the court judgments. And I think both Johannes and Joachim have been clear in saying that it's easier to make the rules compatible with EU freedoms and the court by introducing them as a directive. A possible political tactic by the Commission could be to wait for the US Congress. Why wait for the US Congress? Well, the US Congress should normally revise their own guilty rule, on which the minimum effective tax rule is largely inspired, in autumn, or at least before year end. And the guilty rule would be revised as such that there would also be a new rule introduced, which is called SHIELD. Basically a rule that would sanction, so to say, countries that do not join the minimum effective taxation rule. So imagine that the EU does not find a unanimity to introduce a directive. Smartly, there could be a power play being played by the United States towards EU member states, saying, well, in that case, we will apply our shield to your multinationals at our rate, which means the US rate at the moment, at least as proposed by Biden, would be 21%, which would consist of a very high pressure, politically speaking. So politically, at least for the European Commission, this becomes very interesting. So far, the European Commission, at least the new European Commission, it was more in announcements. Now that there is an international agreement, the Commission needs to act, and how it will be acting, it will be very important, politically speaking, and how the power play will play out in the EU will also be very interesting to follow. Something interesting, and that's my last comment, is the idea of making the minimum tax an own resource for the EU. You might have followed that there's a roadmap for new own resources for the European Union, which includes a digital levy. This digital levy is under high pressure from the United States. Basically, the United States is saying, first of all, delay the proposal of a digital levy, which is planned for the 14th of July. And likely this will be delayed for political reasons, in order not to infringe on an OECD agreement at the G20 level, both in July and both at the G20 summit in October. But who knows, perhaps the digital levy, its design could be changed with some political creativity to the proposal made in this study or in this report. Which I also believe would be much more interesting from a revenue perspective, but also from a political perspective, to make it more acceptable, the minimum effective tax rate in the EU. So those were my comments. I hope they were clear and not too technical and not too quick, but happy to clarify anything I said in the Q&A.
Thank you very much, Johan, for your interesting comments. I mean, probably Johannes and Joachim want to answer to your comments before we go to some questions we have already. Probably it would be interesting to hear your thoughts, Johannes and Joachim, especially to the last suggestion to combine probably a minimum tax based on the water pays principle with a digital service tax, and how this could work out.
Maybe I start. I've not much to add. These comments were mostly complementary to our considerations. So this is, as you said, Dominic, from the field of political economy, where Johan is an expert and we're not. I think the digital levy is a powerful political symbol that may be sacrificed for wide-ranging consensus on other goals. For instance, the pillars 1 and 2. I'm not that convinced that this is actually a good instrument. It seems that the Commission at this point is very much decided to pursue this, but I have no clue whether this is just political power play or whether this is really the desire to have this instrument as a revenue-raising device. As I said, that's not my field of expertise. Joachim?
Yeah, well, I have not really much to add. So, as you said, Johannes, I agree. The digital services taxes we saw spring up globally and also in EU member states, and the proposal by the EU clearly created the pressure needed to bring some countries, and initially especially the United States, at the negotiation table, and that certainly was useful. Now that we get probably an agreement, the question is first, under this agreement, will it still be possible? We don't know yet what will be the outcome. I mean, the United States would have all DSTs abolished and no new DSTs introduced, certainly. Whether this will be the outcome, we don't know yet. If not, if the DST would politically be something that is still somehow accepted, under the condition that it is neutral or whatever, so probably lower thresholds. Still, I'm also skeptical whether this is a good instrument for a variety of reasons, but just one question. What about the incidence? If it's a tax on revenues with a relatively low percentage point, is it not very likely that in the end it's the consumer who will pay the tax? And is this really what is desired? I think the way to go is to expand instead the taxing rights of market jurisdictions or source countries, if that is politically desired, in a conventional way, by creating virtual connecting factors or by expanding the source country withholding tax rights. That is the better way. That is internationally more acceptable and has the same effect of taxing those large multinationals where they make their profits, if that is the new consensus.
All right. I think we should catch 3 questions on the legal side before we move on, probably to the possibility of using revenues for EU on resource. The first question by Alexander Rust is if it's not easier to force member states to levy a corporate tax, minimum corporate tax rate of 15% via the directive directly. The second one is if for Pillar 2 there is probably a new justification ground. I think Johan is citing Juliane Kokot here. Probably your thoughts would be interesting. And Mindy Herzfeld is asking whether, I think the question is about whether the avoider pays principle is also working if not all member states agree to implement the minimum tax in the EU, or whether this could be whether this problem could be solved. I hope I have formulated the questions in the correct way.
Who starts? Johannes, do you want to start?
Joachim, that's for you, I think.
Would it maybe be easier, Alexander, to just force all EU member states to levy 15% corporate income tax? Initially, I would say no, because let's just remember the effective minimum tax initiative is about very large multinational groups of companies, and that is of course different from forcing countries to apply a 15% corporate income tax on all entities, all corporations. You would lose all the incentives, for example, for R&D by smaller companies and so forth. So that's something that goes quite a bit beyond. But under the premise that we would get the BFIT someday in the future, so the ex-CCCTB, a common consolidated tax base, then in my view, it could make sense to say, well, look, we have an allocation, a formulary allocation based on 3 or 4 criteria, so where the assets are and so forth, plus everybody has to apply at least 15% of that. So you could combine the minimum tax with the CCTB or BFIT now, and that is, in a way, requesting that everybody apply at least 15% on those profits that are then allocated under the BFIT. And that, in my view, would make sense. But of course, it is politically quite far away. Next question, based on what Advocate General in her opinion concluded, would the court maybe accept a new justification? Well, as I said, it should not be excluded. It is possible. The court itself has stated in 1 or 2 cases that explicitly stated that it is willing to accept sometimes justifications at an EU level, that it would also accept and not accept at the national level. Well, first question, however, is, yeah, but can we sure, just because Advocate General Cockott thinks this would be a good development, that the court will think so too? And second, would that also happen in case that we have only enhanced cooperation? So not all the member states agree on this. Then the court might be more reluctant to be generous with new justifications, because not everybody agrees on them then. And finally, certainly the court would have to change its case law, and the court has indicated in the Lexel case that an anti-BEPS objective is not enough as a justification. So we have case law telling us the contrary, very recent case law. So I'm a bit skeptical there, even though it should not be excluded. And then what's the next question? Sorry, what can we do if not all agree?
Yeah,
well,
I understood it that way.
Well, if not all agree, as Johannes said, it's either enhanced cooperation or national solos, and of course national solos might go alongside, because that would create the pressure maybe needed at the international or European level. And now let's focusing on the EU under enhanced cooperation. Could you still do the avoid a pays principle? Yes. That would then not lead to any conflicts regarding those who do not participate with respect to the fundamental freedoms, as I've tried to explain. It would, of course, constitute a treaty override vis-à-vis those who do not participate. And the other 25 might say, so what? We don't care. And then what are the 2 or 3 who don't want to go along going to do about that? They're in the weak position then. So I think it's possible. Hopefully that answered more or less all the questions. I'm not sure.
I would like to add just one thing to the first question, that whether we can force member states to just set a 50% tax rate. So fortunately, the effective minimum tax is not about nominal rates, but about effective rates. And the effective rate is nowhere in the tax law. It is, so to speak, the outcome of the nominal rate and very complex tax-based rules. And this is why it is hard to agree on something like a common effective tax rate. Even for a stable tax system, effective tax rates fluctuate over time. This is why we need this step 5, as I said, this smoothing out of the ETR, the tax and loss carry forwards. Right, and so this makes it complicated to negotiate, but this makes the effective minimum tax a very powerful instrument, because it says, well, independent of what you do exactly, we just look at the outcome, whether this is really the tax that you pay. Otherwise, you could just say, okay, write it in your tax law, but if you forget to enforce the tax, to really raise the revenue, then this is not our problem. The effective minimum tax rate says, okay, you really have to pay it. right? And this is why we cannot do this by just agreeing on something on the outcome. We need to measure it and enforce it by levying a top-up tax.
All right, time is moving on. I think we make probably 2 rounds of questions, and I try to combine 2 questions now. One by Sarah Goda, who I think asks if probably using revenues as an EU-owned resource could make the political conflict or the implementation politically more likely, because distributional conflicts are more easily solved. And a comment by Heinz Zurek, who is arguing that probably there are legal challenges to use revenues by a directive based on Article 115 in such a way. Probably we can discuss the issue of EU-owned resources now.
Well, okay, regarding the legal issue, I maybe start. That's an important point. So indeed, it would not be in the directive on how the minimum tax looks like, but it would be possible to use the one-stop shop mechanism if we agree that we do not implement an income inclusion rule, so the revenues don't automatically go to a particular member state. It would then be possible to decide in a budget decision that the revenues should end up with the EU, and then this one-stop shop could be used to bring them there without the need to first bring them to the ultimate parent entity jurisdiction and then up to the EU. I think that should be possible. And then just one point, because someone in the chat claimed it doesn't work because the under-taxed subsidiary, if it has to pay top-up tax in the ultimate parent jurisdiction, it's discriminated against vis-a-vis other subsidiaries or companies in the low tax jurisdiction. That is not a problem under EU law. I'm sorry, because the Court of Justice always looks at the treatment in one and the same member state. It does not assume a supranational perspective, which is also doesn't object to international double taxation. So in the member state where the tax is collected, which is the parent member state, there is no discriminatory treatment. Nor is it in the member state where this subsidiary is, because this member state, the undertaxed payment, the undertaxing member state, collects just as much from this subsidiary as from any other subsidiary in this country. And so there is no discriminatory treatment unless you assume a supranational perspective, which the court does not do when it comes to restriction. So that's just wrong.
Okay, using the revenue as an own resource doesn't make it politically more or easier to implement. This may go both ways. I would like to hear Johan's opinion on that. But my intuition is that member states may just be asking, why go through the hassle of implementing all this? This has a certain resource cost, right? So on the administration's side, capacities must be built up. If there's nothing left on the side of the member states, I would guess that this may be a hurdle. Otherwise, yeah. But Johan, maybe you could add to that.
Yes, quickly. No, I mean, the idea of making this as such an own resource, I think, is wishful thinking. But we do have the roadmap for new own resources, what was ratified by all EU member states, and it includes the idea of a digital levy, but it does not include how the digital levy should be designed. And it's that design that is very important, and that design has not yet been published. It should be published on the 14th of July, but likely will be postponed. The idea now at Commission level is to have a kind of a digital services tax, but revised, meaning a broader scope, so that it's not anymore discriminatory towards US companies. At least that's what the US had claimed with the previous digital services tax, because it was touching more US multinationals, or at least the big tech giants from the US, and less European ones and other non-US ones. But in the public consultation for that digital levy, there was also a proposal for a corporate top-up tax. Meaning we could imagine that a share of corporate tax revenues from member states could be transferred to the EU budget, and this would then be considered as a sort of top-up tax. It would be then up to the member state to decide: do you want to levy more taxes on your companies to feed in the EU budget, or do we just take a percentage of the corporate income tax revenues from our country to the EU budget? I mean, it was not clarified in the public consultation how it would be designed, but at least those were the ideas floating around. So if you take that idea in combination with a Pillar 2 implementation in the EU, you could imagine then revenues from that Pillar 2 would be then indirectly integrated in such a corporate top-up tax. And why I have been defending always the idea of a corporate top-up tax as a EU-owned resource is that it does not enter into conflict with the US, because it has less this digital branding, which the digital levy now carries because of its name, and now because also of the idea to make it again a digital services tax.
All right, interesting perspective. I would say we make a last round of questions. I think very interesting is the question if there are external effects via an implementation by enhanced cooperation, if there is an incentive to relocate within the EU to not implementing countries. And also the question whether countries only implement the income inclusion rule and not the under-tax payment rule, what the opinion is on such a implementation.
Yeah, maybe I start with that. Yeah. Very good question. That really depends on how the enhanced cooperation will look like, and if it has the full set of instruments, that means the income inclusion rule and the under-tax payment rule, it's not likely that there is a strong incentive to relocate your own firm to a country that is not participating in that, because there is this under-tax payment rule that would still bite, right? But yeah, so it would be, in any case, it would be preferable to have a broad-based application that this is from the start, this is not an option that you can actually draw. And the income inclusion will, at least from my reading, always be more effective than the application of the under-tax payment rule by many locations. Yeah, the effort or the cost of coordinating this may be high, and if the resulting revenue per location that applies the UTPR is low, then there may be some leakage.
Okay. Yeah, I would like to add that, of course, the UTPR is an important backstop, as the blueprint writes, to prevent precisely relocations. On the other hand, it is not the only one. For example, we do have things such as exit taxes, which now, according to the ATAD, may and must indeed even be levied within the EU. So there are some instruments that also make it less attractive to have relocations or inversions. However, I mean, the bottom line is that, and in this way the question is justified, if we have a critical mass, a relatively large number of industrialized, developed holding locations that do not want to participate, then the minimum tax cannot be as effective as it would otherwise be, because there will be some relocation and inversion. So that is a truth that can't be denied. And in the end, my assumption is within the EU, over time, it will be resolved by political pressure.
Johan, do you want to add something? Final comment?
No, thank you.
All right.
New scandal out, Lux Letters, published at 7 p.m. today. So it's a big tax day. All
right, so we have to check it out. thank you very much to you, to the presenters, also to the audience for the questions. I hope the webinar gave a few of you new ideas to solve the multiple technical questions that come with an effective minimum tax implementation, not only at the EU level, but also at the EU level. And yeah, to move this important project forward. Again, many thanks from Arbeiterkammer and ÖGB, and hope we stay in discussion on this important issues. Thank you very much for participating. See you.
Bye.
Bye.